Right now, something unusual is unfolding inside the global silver market, and most investors haven't noticed it yet. Silver prices on the surface appear calm, trading in a relatively narrow range around the mid-20s per ounce. But beneath that quiet surface, the market structure is beginning to shift. In several physical markets around the world, buyers are suddenly paying large premiums above the official futures price just to secure real metal. That kind of behavior rarely appears in stable commodity markets. It usually happens when demand starts colliding with limited supply. Dealers in Asia and parts of Europe have reported shortages of certain silver bars and coins, while industrial buyers are locking in long-term contracts to guarantee future deliveries. At the same time, inventories stored inside major trading hubs such as the COMEX vault system have been gradually declining, reducing the amount of silver that can actually be delivered into the futures market. These signals may look small individually, but together they are creating a picture of tightening supply conditions. Silver is not just a precious metal used by investors. It is also a critical industrial resource powering solar panels, electronics, medical equipment, and advanced manufacturing. That means the silver market sits at the intersection of financial demand and real-world economic activity. When both types of demand increase at the same time, the system can begin to experience stress. The question investors are starting to ask is simple but powerful. Are we witnessing the early stages of a silver supply shock? If the answer is yes, the implications for prices could be dramatic, because historically, silver tends to move quickly when the balance between supply and demand suddenly shifts. At first glance, a tightening silver market might seem like a niche story, affecting only precious metal investors or commodity traders. But in reality, silver plays a far larger role in the global economy than most people realize. It is one of the most widely used industrial metals on Earth, appearing inside everything from smartphones and electric vehicles to solar panels and medical devices. Every year, the world consumes hundreds of millions of ounces of silver in manufacturing processes, and many of those applications have no easy substitutes. As the global economy continues transitioning toward electrification and renewable energy, demand for silver has been rising steadily. Solar panels alone consume massive amounts of silver because of its unmatched electrical conductivity. That means any disruption in silver supply can ripple through entire industries. Manufacturers may face higher input costs, production delays, or shortages of key components. When those costs rise, companies typically pass them along to consumers in the form of higher prices. In other words, a tightening silver market doesn't just affect investors. It can influence inflation, supply chains, and technological production worldwide. There is also a financial dimension to the story. Precious metals like silver often act as alternative stores of value when investors lose confidence in currencies or financial systems. During periods of economic uncertainty, investors frequently move capital into metals as a hedge against inflation or currency instability. That dual role, industrial metal and monetary asset, makes silver uniquely sensitive to global economic conditions. If both industrial demand and investment demand increase simultaneously, the pressure on supply can intensify rapidly. This is why analysts across commodity markets are watching silver closely right now. What appears to be a small supply imbalance today could evolve into a much larger market disruption if demand continues rising while inventories remain constrained. The current attention surrounding silver didn't emerge out of nowhere. It began with a series of developments that quietly started appearing in market data over the past several months. One of the first warning signs came from the physical silver market in Asia. Dealers began reporting unusually high premiums for large silver bars, sometimes exceeding $10 per ounce above the benchmark futures price. In commodity markets, premiums of that size are extremely unusual because they suggest buyers are willing to pay significantly more just to obtain immediate physical supply. At the same time, delivery requests on major exchanges began increasing. Futures contracts for silver allow traders to either close positions in cash or request delivery of real metal. Normally, only a small percentage of traders choose delivery, but recently, analysts noticed a gradual increase in the number of contracts moving toward physical settlement. Meanwhile, inventories inside major vault systems continued declining. COMEX, the largest silver futures exchange in the world, tracks how much metal is stored and available for delivery. Over the past few years, those inventories have experienced periodic drawdowns, reducing the buffer that normally stabilizes the market during periods of strong demand. The combination of rising premiums, increasing delivery interest, and declining inventories has started attracting attention from institutional investors. Some hedge funds and commodity analysts are beginning to question whether the futures market price still accurately reflects real-world supply conditions. These developments don't automatically guarantee a supply crisis. Markets often experience temporary imbalances that resolve themselves over time. However, the speed and consistency of these signals have raised a critical question. Is the silver market approaching a structural shift where physical supply begins to dictate price movements more aggressively than paper trading? If that happens, it could change the dynamics of the entire market. To understand why a potential silver supply shock could occur, it's important to examine how the silver market actually functions. Most people assume the price of silver is determined by physical buying and selling of the metal itself. In reality, the global benchmark price is primarily discovered in futures markets, where traders buy and sell contracts representing silver rather than the physical metal. These futures contracts allow market participants to speculate on price movements or hedge industrial exposure without needing to store large amounts of silver. While this system improves liquidity and efficiency, it also creates a situation where the amount of paper silver traded each day can exceed the physical supply by a massive margin. In some estimates, daily futures trading represents hundreds of ounces of silver for every ounce that actually exists in exchange vaults. This imbalance usually doesn't cause problems because most contracts are settled financially, rather than through physical delivery. However, if demand for real metal suddenly increases, either from industrial buyers or investors seeking physical ownership, the system can begin to tighten. Exchange inventories then become extremely important because they serve as the buffer between paper contracts and physical supply. If those inventories shrink while demand rises, the market may experience a squeeze where available metal becomes scarce relative to the number of outstanding contracts. In that scenario, prices often need to adjust upward to restore equilibrium between buyers and sellers. This mechanism has appeared in several commodity markets throughout history. It doesn't necessarily require a complete shortage of metal. Sometimes even a moderate supply imbalance can trigger large price movements if confidence in the availability of physical supply begins to weaken. When commodity markets experience supply shocks, the consequences rarely remain confined to trading screens. They ripple outward into real economies, affecting businesses, workers, and consumers. Silver's role as both an industrial metal and an investment asset makes those ripple effects particularly powerful. For manufacturers that rely heavily on silver, especially companies producing solar panels, electronics, and precision equipment, rising silver prices can quickly increase production costs. Many of these industries operate on tight profit margins, meaning even small changes in raw material prices can force companies to reconsider pricing strategies, production schedules, or investment plans. If silver becomes significantly more expensive or difficult to source, manufacturers may slow production or pass costs directly to consumers. That can translate into higher prices for technology products, renewable energy equipment, and electronic devices that millions of people rely on every day. Small businesses involved in electronics repair, jewelry production, or specialty manufacturing may feel the pressure even more intensely because they often lack the financial flexibility to absorb large increases in raw material costs. On the investor side, volatility in the silver market can also trigger sharp swings in mining stocks and commodity funds. Mining companies may initially benefit from higher prices, but rapid price spikes can also create uncertainty in long-term planning and capital investment. Financial markets tend to react quickly to commodity shocks, which can amplify volatility across related sectors. In extreme cases, supply disruptions can even influence national economic indicators, such as inflation or industrial output. This is why commodity supply shocks historically attract attention, not just from traders, but from policymakers, economists, and central banks, attempting to understand how raw material markets influence broader economic stability. One of the factors that could intensify pressure in the silver market is the global transition toward renewable energy. Governments around the world are investing heavily in solar infrastructure as part of long-term climate and energy strategies. Solar panels rely on silver for their photovoltaic cells because of the metal's exceptional ability to conduct electricity. As solar installation expands globally, demand for silver has been rising steadily. Analysts estimate that solar manufacturing now consumes a significant portion of the world's annual silver production, and that share could continue increasing over the next decade. This structural demand growth creates a situation where industrial consumption may rise regardless of short-term economic conditions. Even if certain sectors slow down temporarily, renewable energy investment often continues due to long-term policy commitments. That means silver demand from solar production may remain strong even during periods of economic uncertainty. At the same time, mining supply cannot always increase quickly enough to meet rising demand. Developing new mines takes years of exploration, regulatory approval, and construction. Many silver deposits are also produced as byproducts of mining for other metals, such as copper, zinc, or lead, meaning silver supply is partly dependent on the production decisions of other mining industries. If demand from renewable energy continues expanding, while mining supply grows slowly, the market may experience sustained pressure over time. This dynamic doesn't necessarily create immediate shortages, but it gradually tightens the balance between supply and demand. When that tightening occurs alongside rising investor interest or declining inventories, the combined effect can amplify price movements. In other words, the renewable energy transition could act as a structural force that quietly supports silver demand for years to come. Another factor influencing the silver market is the broader macroeconomic environment, particularly monetary policy and currency stability. Precious metals have historically acted as alternative stores of value during periods when investors lose confidence in traditional financial assets or fiat currencies. Over the past several years, global economies have experienced unusual levels of monetary expansion, rising debt levels, and persistent inflation concerns. Central banks around the world responded to economic disruptions with aggressive stimulus programs, dramatically expanding balance sheets and injecting liquidity into financial systems. While those policies helped stabilize economies during crises, they also raised questions about long-term currency stability and inflation. When investors begin worrying about the purchasing power of money, precious metals often attract increased attention as hedging instruments. Gold typically receives the most attention in these scenarios, but silver frequently follows similar trends, often with larger price swings due to its smaller market size. If inflation pressures remain elevated, or central banks begin easing monetary policy again, investment demand for silver could rise alongside industrial demand. This combination creates a powerful dynamic because it brings both financial and industrial buyers into the same market simultaneously. Additionally, geopolitical tensions and supply chain disruptions can influence mining operations and transportation of raw materials. Political instability in major mining regions or logistical disruptions can temporarily reduce available supply. While such disruptions may be temporary, they can still intensify price volatility when markets are already experiencing tight supply conditions. In this way, macroeconomic forces, geopolitical developments, and financial market psychology can all compound existing pressures in the silver market. If the silver market were to experience a sustained supply shock, the effects could extend beyond individual industries and influence national economic strategies. Countries that depend heavily on silver for manufacturing, particularly those involved in electronics and renewable energy production, may face increased costs for essential materials. Governments investing billions into energy transitions could find project budgets expanding if the price of silver rises significantly. At the same time, nations that produce large amounts of silver may experience economic benefits through increased mining revenue and export earnings. Countries such as Mexico, Peru, and China play major roles in global silver production. Rising prices could strengthen mining sectors in those regions, potentially increasing employment and investment within the industry. However, higher commodity prices can also create volatility in global trade relationships. Import-dependent countries may face higher manufacturing costs, while exporters benefit from improved revenue streams. Additionally, silver's role in financial markets means price volatility could influence investment flows between asset classes. If investors perceive silver as an attractive hedge during economic uncertainty, capital may move from equities or bonds into precious metals. Large shifts in investment flows can influence currency markets and financial stability, particularly if they occur during periods of broader economic stress. Policymakers and central banks, therefore, Monitor commodity markets carefully, because raw material price shocks can influence inflation trends, industrial production, and consumer prices. While silver alone does not control global economic outcomes, it interacts with multiple sectors that collectively shape economic growth and technological development. This is why analysts are paying attention to the current tightening signals emerging in the silver market. The silver market today sits at an interesting crossroads. On one side are the traditional forces that have always shaped commodity markets: mining supply, industrial demand, and investor sentiment. On the other side are new structural factors, including renewable energy expansion, evolving monetary policies, and increasing geopolitical uncertainty. When multiple forces converge in a single market, the result can be periods of dramatic volatility. The signals currently appearing in silver, declining inventories, rising physical premiums, and increasing industrial demand, suggest that the balance between supply and demand may be tightening. However, markets rarely move in a straight line. Temporary corrections, economic slowdowns, or shifts in investor sentiment could still moderate price movements in the short term. The key issue to watch is whether physical supply continues tightening while demand remains strong. If inventories continue falling and buyers increasingly demand physical delivery rather than paper exposure, the market structure could eventually adjust through higher prices. Historically, commodities experiencing structural supply pressure often move through cycles of sudden repricing as markets attempt to restore equilibrium. Investors watching silver therefore face an environment filled with both opportunity and uncertainty. Understanding the underlying market mechanics, rather than reacting to short-term headlines, is essential for interpreting what happens next. The coming months will likely reveal whether the current signals represent a temporary imbalance or the early stages of a more significant shift in the silver market. Either way, the developments unfolding today remind us that commodity markets often change quietly before major price movements occur, and those who pay attention to early structural signals are usually the ones best prepared when the market finally reacts.